Welcome to the podcast about investing in startups, where existing investors can learn how to get the best deal possible. And those that have never before invested in startups can learn the keys to success from the venture experts. Your host is Nick Moran, and this is The Full Ratchet.
Welcome to another special release of Investor Stories. On this installment, the experts discuss a startup that they did not invest in, why they passed, and if there was a key learning that now informs their approach. Here's the segment called Why I Passed.
On today's special segment, we have Alex Osterwalder, the creator of the business model Canvas and founder of Strategizer. Alex, can you tell us about a good or a bad pass, a story about a startup that you passed on?
Personally, no. Actually, I've been very lucky with the early stage investments that I made. One company called Monito, another company called ShapeScale. So I've been pretty lucky. No pass, but I have seen, these kind of things happening in established companies because they think it's about the big bets rather than spreading their bets into many, many different areas so they would kind of capture where the world is going. So it's more from the corporate world that I've seen those things than from my personal investment experience.
On today's special segment, we have Scott Kupor of Andreessen Horowitz. Scott, can you tell us about a good or a bad pass, a story about a startup that you passed on?
Yeah, sure. Talked about this a little bit in the book, but we were lucky enough to see Square at the very first round of financing, and we passed on it largely because at the time, people may not remember, but Jack Dorsey was actually not the CEO of the company. He was kind of chairman and wasn't entirely sure about what his long-term commitment to the business was, at least at the time they raised that. And he had another person, a guy named Jim McElvey, was actually running the business at the time. And, we felt strongly that we thought Jack was probably, kind of the most interesting person who could run that business. And we passed on that basis, which turned out to be a mistake in many respects, not the least of which that Jack also concluded about 3 months after they raised capital that, he was going to commit, effectively full time to this business. And, obviously, as you can imagine, the history is written in what I think they're reporting earnings actually as we're talking today. So at least a $30 billion company, if not more. So sometimes these things are painful. It's those mistakes of omission that really kill you. But, look, unfortunately, that's the nature of this business. And you hope you get at least your fair share of those.
Is it the commission or the omission that keeps you up at night?
To me, it's the omission. The commission, look, it sucks, as you know, it sucks when you lose money, but that's the nature of the business. And I think we all know going in that the likelihood is a significant portion of what we do is going to end up that way. But, it's hard when you miss a Square or you miss a Twitter or a Facebook or an Airbnb or a Lyft. There's only so many of those companies that effectively have that asymmetric return profile. And, it's hard to get to your target returns as a fund if you don't at least, pick up one or two of those every now and then.
Well, fortunately for you didn't miss on a number of those.
Yeah, we've been very lucky. Yep.
On today's special segment, we have Cheryl Cheng of Blue Run Ventures. Cheryl, can you tell us a story about a good or a bad pass? So a story about a startup that you passed on.
Sure. Let's see. There's a company that we looked at, I would say 6 or 7 years ago, a company called Mixpanel. And we looked at it really closely. And it was probably one of the companies that, we look back on and we said, wish we'd done that, just because we saw a lot of the signs that, it would be a good business. And we knew what adoption of mobile apps would be. I forget exactly the details of how we passed or why we passed, but, as we watched that company do well, that's one that we wish we had done. Another one that we wish we had done was Hotel Tonight. We saw that a little bit late in their fundraise process. And so it kind of came a little fast and furious for us. We couldn't get comfort with it quick enough, which kind of points to, I think, the passes that you generally regret are because you feel like you could get comfortable if you had spent more time in the space, right? So that you were ready to see the important things to help you make a decision. Of course, it's almost impossible to cover all spaces all the time and, be like up to speed and like waiting for the, the potential unicorn to just appear and be like, yes, you. But that's what we're supposed to do, right? Like, I mean, as investors, we're covering all these segments. Like you almost get dizzy, like context switching all the time, but that's our job. And so I kick myself when I feel that we haven't adequately covered some spaces as well as we should. And so we don't have a thesis as developed as we could have developed. And so in those instances, we pass instead of leaning in. And then later we realize, well, had we had a more developed thesis, of course we would have said yes. So I think that's what happens, at least for me, most often, where when I look back, let's say a year later, I'm like, oh, like I wish I had done that.
The ones that come late in the fundraising process are always tough from an omission or a commission standpoint. I find that poor decisions are often made when it's, under the gun and you've got less than a week and you got to try and develop, a conviction in no time at all.
Right. And get your team to have the conviction, right? So it's just and it's not about how many hours of discussions you can have. It's just, you just need time. So one of the things that I always try to do is I try to meet founders when they're raising their seed round. The reason is that if it's a space that we really know well and we have high conviction in, where we think we can add value, we can lean in, kind of one of the larger seed round type constructs that you see today. But if we don't, but we really like the founder, what we do is we open up our network and we open up our time, and we're always willing to stay in touch, often meeting every quarter just to get updates so that we can be ready for the A. And in those cases, when the A comes pretty quickly, we're actually really ready. So one of the companies that I invested in, actually almost exactly this time last year, we knew the founder for almost 3 years before we wrote the Series A check.
Wow.
And in the early days, we liked her a lot. We liked the space. We didn't love her go-to-market strategy. And we told her that. And as she evolved it, and she said, these are the milestones I'm setting for myself. And when she came back with the A, it was very easy to get on board, and it all happened very quickly. But, we spent years developing a relationship. And when she came out for her A, there was a lot of trust that was already built up, that we knew her, we knew how she worked, her business. And so that's the ideal scenario. And I have no problem putting in the time to founders that are not in our portfolio, or we haven't, it's not, again, I don't like the transactional, right? So I don't like the idea that, you're either in the tent or out of the tent. So I think of like that, it should be much more fluid than that. And so I like just really good founders. And there have been founders who I really like, and I tell them, you shouldn't take venture money because there are better ways to build your business, that once you take venture money, then everything's focused on growth, everything, and you go down a particular path that might not be the right path for you. You can still have a really good outcome as a founder. And so I'll have those conversations, and, I'll also tell them, you can feel free to contact me and chat about anything related to your business if you want to. And some founders take me up on it, and some don't for whatever reason. But, I really do mean it. And I think ultimately we're here to champion entrepreneurship in general. But of course, there are ones that we think we can add value to by putting money in. But that's how we think about it. But you're right. The fast ones, they're hard. They're really hard to do.
Right.
So you feel like there's a gun to your head and you have to make a decision.
Yeah.
Yeah. Those ones are definitely more challenging.
That will conclude this installment of Investor Stories. If you're enjoying the program and would like to see it continue, take a moment and leave a 5-star review in iTunes. Also, if you'd like updates on new content from TFR, as well as the top 10 VC articles every week, go to fullratchet.net and sign up for the newsletter. Okay, that will wrap things up for today. Until next time, over-prepare, choose carefully, and invest confidently. Thanks for joining me.